Welcome to another episode of the Multipliers Podcast. I'll be your host for today. My name is Mahdi, and it is my pleasure to introduce our esteemed guest, the Executive Vice President and Head of Research at Ramz Capital, Amer Halawi. Amer, thank you for joining me on today's podcast.
It's a pleasure to be here, Mahdi.
Well, let's start by a quick intro about yourself.
Sure. My name is Amer Halawi. I'm Arabian-born, European-bred, and North American-educated is how I would summarize myself. I'm an Executive Vice President at Ramz Capital and the Head of Research. Ramz Capital has been a solid driving force behind UAE capital markets for the better part of 25 years. And I was lucky to be called in by the CEO, Karim Shaib, who's a personal friend of mine and a former colleague, to take care of research. The stock market has been a personal passion of mine for the better part of 30 years now, and I've been at it for that long. I want to say that the reason why stock markets are particularly fascinating for me personally is because of the psychology. You know, people think about the stock market as numbers. I think about them as psychology and stories, and I'm happy to discuss that with you if you think that's a point of interest. So that's me in a nutshell.
Yeah, we should definitely do that. But let's start with a very important topic, which is, and this is your area of expertise, why do companies go public?
Yeah, that's a great question. I mean, they go public to raise money, right? They want money. Now, why they want to raise money is the real crux, is the real question. So they can do it for many reasons. Either they want to expand, or they want to buy out other companies, or they want to monetize a long-held asset. That can be the case of families which started a business, perhaps 100 years ago, and some generations want to take some profit off the table. It can be the case of venture capitalists or private equity investors who want to take some money off the table. It can be a liquidity event to change ownership. It can be for fiscal reasons. It can be for publicity reasons. Some people think that it's a good reason or good way for their companies to be public in order to garner interest, to be visible, for people to see you. So there's really many, many reasons behind why people go to market. Sometimes the reasons are valid. Sometimes they are less valid. And the really important point in all of this is the storyline. I mean, you guys know one thing or two about marketing, and it's the same. It's all about the story. So does the money-raising exercise, does the IPO tie in with the fundamental story, with the next step in the life of the company or not? And this is what we're really going to look at to gauge the importance of this event for any company.
So from what I understood from what you said, it's about the narrative and the real reason why the company's deciding to list.
That's correct.
So it's a blend of both.
Absolutely.
So you listed like 10 reasons why a company should list. So in your opinion, because we're seeing a lot of companies listing in our part of the world, and it's been a very big boom in the GCC market. So are you seeing a lot of these reasons why companies are listing, or is it a bit different from what's happening in, let's say, China or North America?
That's a critical question, really, Mahdi. And I'm going to take the long route to answer your question.
Okay.
My daughter came to me at a very young age and asked me to explain what I do. Now, with a child of 10 or 12 years old, it's quite complicated. So again, you need to create a story to explain what you do. And this is what I said. She likes ice cream, like every kid. And I said, you want to sell ice cream? You buy an ice cream truck, you go on the Corniche, you start selling ice cream. Now, you bought that truck with your own money, with your own savings. You're so successful, people love your ice cream, you decide to buy another truck. You don't have money, you go to the bank. The bank says, oh, you have a truck. I'm going to lend you money to buy a second truck. You buy your second truck, and you're still selling a lot of ice cream. The bank has reached the limit of how much it can lend you, so you go to the stock market because you decide that now you want to take on the world. You want to become, Ben & Jerry's. You want to become Häagen-Dazs, and you're not going to be able to do it with your local bank or your family and friends who lent you money in the first place. So you go public, you raise that money, you give a stake in your business, and you allow people to share your success. And these people allow you to go to the next level in your journey. This is a typical business school example, I would say, of why a company would go public. Look at the Silicon Valley, hungry young people with bright ideas. They think they're going to change the world. They don't have a dime. They're sleeping on the street, right? And they go to Silicon Valley. They meet savvy investors who love the story that they hear. They help them raise the funds. They help them go public. Mm-hmm. And then you get Apples, and then you get Amazons, and then you get Airbnbs, and so on. So this is the typical example.
And here in the region,
great idea. People need money to move forward. Here, and I asked some of my fellow investors who are specialized in emerging markets, it's a very distinct situation, right? Do we need money? Does the UAE government need money? Do UAE companies, which are mostly attached to, in some way, shape, or form, the government, do they need money? I don't believe so. I mean, the UAE government is one of the least indebted in the world, yet we issue debt. Does the UAE government issue debt because the government needs money? No, the government issues debt because it needs to, build a yield curve. It needs to be on the map in some way. Let's look at the equity part of the story. Let's take the example of very successful companies with fantastic management, great transparency. The ADNOC ecosystem is exemplary, right? So the ADNOC companies are now listing one after the other quite successfully. Does ADNOC need money? This is one of the largest oil-producing companies in the world. Surely not. So why do they list? For many other reasons. That's a very wide topic, but I would say some of the reasons that we mentioned earlier: publicity, being on the map, having a liquid stake, being able to purchase companies with stock, perhaps redistribution of wealth, right? These companies are dividend distributors. Mm-hmm. Dividend distributors are doing something for the people, something for the market. They are creating an interest. They're attracting people and investors to this part of the world by allowing them to share a piece of the pie. And so they don't need money, but they still need to come to market. They don't really need to come to market, but it's a great instrument for them at their service to come to market. It allows markets to flourish. It allows their ecosystem to flourish. And by the way, it's a very smart move as well, because it allows the market to value their previously private business, and still to a large extent private business, and to value it much, much better than if it were still in closed circles. So ticking many boxes, but not raising money because they need to.
Because they need to. But whether a company needs the money or doesn't need the money, but they still decide to go public, they have a responsibility towards shareholders. So let's talk about that a bit.
Yeah. So before we do that, and that's a very important implication, I want to say that going public is a big step, right? It's a cultural change. And I want to diverge before I go back to your question. Think about Goldman Sachs, right? Goldman Sachs is a very visible name, has been listed since 1999. This was a partnership and was renowned for its partnership status. It took years of deliberation for the partners of Goldman Sachs to decide whether or not to go public. And then they made the decision, and it's probably one of the most talked about and written about topics in the financial world, is the migration of Goldman Sachs from partnership to a publicly held corporation. And the reason is because these are cultural changes. These are very significant cultural changes.
We went through one ourselves when we listed 2.5 years ago.
Absolutely. There you go. And so the company, the people, the owners, the founders, the originators, everybody, the ecosystem needs to be ready for that cultural change. And sometimes it takes years of preparation. And if it's done well, and let me go back to the example of Goldman Sachs, right? So 1999, 25 years later, the stock is up nearly 500%. That's 20% per year. And we've gone through the LTCM crisis in 1999, 2000. We've gone through the great financial crisis. We've gone through COVID, all of these things. And yet we're clocking 20% per year. Why? Because the story is a compelling story, because the narrative has been worked on and it's been fine-tuned and it's been pitched and it's been a steady course. I mean, we can take examples of other companies, but I thought that this one would be particularly telling. So IPOs are not a joke. We don't just wing it. We don't just wing an IPO, right? We prepare an IPO. We get ready for it. We get the story right, we pitch it right, then we go public, and then we have a responsibility. And this is where your question comes in, the responsibility and what happens when companies list. So let me put it this way. I go back to the ice cream truck, right? So let's pretend for a second that you're part of my family.
I am part of your family.
Exactly. Thank you.
We're both Lebanese, so yes.
Absolutely.
Yeah.
And you lent me those original dineros to buy my ice cream truck, right? So you trusted me with your money. What do I owe you against that trust? I owe you everything. If I'm a Silicon Valley young person in my 20s and I have a dream and I come to you and you decide to trust me with your bucks, what do I owe you? Especially if I then make it. I owe you everything, because without you, I'm nothing. This is the kind of responsibility that I personally have in mind for companies that go public towards their financiers, but let's move the money aside for a second, towards people who have trusted them with their guts, with their vision. What do you owe somebody who trusts you? You owe them everything. So now practically, if you go back to finance and the number in the stock market, what does a listed company owe to the public that has invested in its shares? It owes it clarity. It owes it trust. It owes it transparency. It owes it to take it on board as if it were an owner, because it is an owner, and to tell everything to that owner that this owner needs to know about the company, good or bad.
Whether you own 1 million shares or 1 share.
Absolutely. And this is the beautiful thing about market regulation, and this is where we start stepping into the more practical aspect of things, is we owe symmetrical information to shareholders. We are not allowed to discriminate between shareholders. Otherwise, there's mistreatment of one to the benefit of another, and this is forbidden. And of course, it's unethical, so we don't want to do it. So whether you own 1 share, as you said, or 1 million shares, it's the same. I owe you the same kind of information. And what kind of information do I owe you? Let me take a difficult example. Companies, just like human beings, by the way, right? Because companies are ecosystem, they're alive, they're human beings. Or they're living beings, non-human, but living beings. So people go through crises, right? Adolescents go through crises. Professionals go through crises. Couples go through crises. Everybody does at one point or another go through a crisis. And companies do the same. I remember in my school days when I was still a university student, we had a special course about crisis management. And I'm sure you, being a marketing specialist, have, or a communication specialist, as a matter of fact, have a lot of knowledge about crisis management. The first rule of crisis management is you get in touch and you disclose, right? This is the ultimate example of what to do in a difficult situation. Well, in everyday life, it's the same. Let's go back to another example of real life. Parenting, right? Parenting is about explaining, guiding, showing the way. And it can only be done in one proper way, which is talking, explaining, right? Showing the way by transparency and guidance. Companies are the same, right? So again, let's go back to the heart of the topic. What does a listed company do when it does it best? It communicates on a regular basis. It talks to its equity holders. It explains the story. It repeats the narrative. It goes into the details. And this is where disclosure comes in of everything it does day in, day out, down to, let's take the example of American companies, right? Disclosing the compensation of the C-suite, right? Chairman, board members, CEO, CFOs, everybody discloses the number of shares they own and how much they earn. And that's the extreme example of the beautiful transparency in the American system, which culturally may or may not function in other parts of the world. But guess what? We owe this to our shareholders.
Yeah, oddly enough, we just finished a roadshow yesterday. And one of the questions that were asked our CIO who was with us on the roadshow was, how are you compensated? So is it based on the number of deals that you close, or is it based on other metrics? And the guy was very open, and he said, no, it's based on the IRRs. It's based on the level of entry that we come in. So if it's at a high multiple, if it's a low multiple, so the lower the multiple, So it's a mix between the KPIs that he has to hit, okay, and that determines how much money he makes as a bonus and his fixed salary. So it's not just about. So he was very transparent about it. So yeah, I mean, as investors, they do have the right to come and ask such questions. And as listed companies, I think I support you in that. We do have the responsibility to come and tell our investors that we don't earn all those exorbitant salaries that people might think. It's all KPI driven.
Yeah. And so the answer your answer to your investor was the right one. And the right answer is just to answer honestly and genuinely and be able to divulge this information. And there's another reason why you need to do that as a listed company. And I'm not talking about you specifically or your company specifically, but every listed company. You are in the market partially, sometimes totally, for valuation reasons, right? You want to value your asset. You want people to value your asset in the proper way. And there's two ways to do this. You can either pretend that your asset is worth what you think it's worth and sell me the dream of, hey, this asset is worth so much. Or you can give me the information to allow me to value your asset in the way that I should value it. And there will be many people with multiple different valuations, but this is the market, right? This is the free market. So give me the tools, let me do my valuation, trust yourself, trust your story, trust me. And this is the best way to do it, because ultimately we are in an offer and demand scenario. And if you're doing your job right, if you're pitching the story right, and if your story makes sense, of course, then there's no doubt that the market will value it in the best way it should.
And that's the art which we refer to in our industry as investor relations.
Absolutely. And I like your transitions, Mahdi. I mean, you know the business, obviously. Investor relations, yes. Now, and I'm going to take an example of another market. I'm going to look at the S&P 500. I'm going to perhaps jump into a topic that we might discuss later, but 500 of the 500 S&P companies are covered by analysts. And covered by analysts means that the analysts have access to all the information they need to understand and assess the companies and value them and put a share price target on them. And sometimes the valuation is going to be to the advantage of the listed company. Sometimes it won't, because markets have a life and they go up and down, and stock prices go up and down. And sometimes, companies are cheap and sometimes they're expensive, and that's fine.
And the analysis is independent.
And the analysis is independent, and everything is made so that the analysis should be independent. But it's the rule of large numbers, right? I mean, 500 companies with 10 analysts or more covering every company, that's a lot of analysts. So in the end, it's going to be a good perspective on the value of the company. But guess what? And this is what I want to get to. These analysts cannot do their job if they don't have the level of information that they need. And the level of information that they need is very detailed because they build models, they get into the granularity of the accounts, balance sheet, income statement, cash flow. For 10 years past, 2 years forward, they rely on companies to give them guidance on what they're seeing, what the market is doing. Is it growing? Is it not growing? Is it changing? So they need that perspective. And that perspective is a big job to feed to the market. I mean, it is a full-time job. And that's the job of IR. And this is why every serious company which is listed, which is in the market, has an IR function. And IR is a pretty big job. It's very technical. It's very strategic. It's very important. And ultimately, it is the, I would say, guarantor of value, right? So if you see it as such, you will hire an IR person immediately. And I'm not talking about you, but I'm talking about every single listed company out there. Now, in the UAE, in the GCC, and in the wider MENA, this function is still nascent. It's nascent because we are in an emerging part of the world. Our stock markets are emerging. The practices are emerging. So there might be some pressure from the authorities, from the government, from the
regulators,
exchanges, etc., to organize the markets better. But companies don't always know. They have to, experience it. They have to see what happens to their share prices in the absence of IR. And they need to realize eventually that they need IR. And this is what's happening now in this part of the world, is that this realization is progressively and slowly seeping in. But what I want to say is that I came here in the early 2000s, and in 2005, I was a very big advocate of, personally, and in the company I was working for at the time, very big advocate of transparency, disclosure, IR, and taking companies to the next level. And I even went as far as mapping the board memberships of every company in the GCC and crunching statistics about those boards down to, and this was in 2005, this was 20 years ago, down to female representation on boards. And what happened after that is I got called in by the World Bank and invited to Washington to talk about this topic because it was so critical, so important, so sensitive, and so early in the stock market life of the UAE and the GCC. Now, things have changed now, right? We've gone the right way, and to some extent, we're doing a lot of things the right way in the UAE, at least. We have female CEOs, we have female board members, we have female ministers.
About the board members, every publicly listed company in the UAE has to have at least one female board member.
Exactly. So this is an example of where the regulation is helping the evolution of the market. And I think that, we are very lucky, you and I, to be sitting here in the UAE with visionary management, right? The management of this country is visionary in every way, down to the stock market structure. But companies are living organisms, and the most difficult thing about human beings and living organisms is change and change management. So this change is slowly taking place. It will take more time, but it will happen, I'm sure. And so I want to end on this point by saying that and I started and then drifted because it's a fascinating topic. This is what we do at Ramz. This is what I do personally. People call me every day. And as a matter of fact, just this minute, on the back of my head is the proposal that I'm going to be making to handhold one company to the IR experience. Why? Because we are specialists. We know what we're doing. I mean, I've been doing this for 30 years, right? So in multiple markets. So we go back to the trust. People trust us. They want a share of our expertise, and they want us to show them the way. Now, the way is sometimes expensive. It's expensive in resources. It's expensive in money. It's expensive in effort. It's expensive in time. But you know what? If you want a good outcome, you have to invest in it.
Let's dissect it a bit.
Sure.
So let's talk about the key components of an effective IR strategy.
Again, I go back to the story, and the story is a journey. You don't push a button and make it happen, right? If you want to make it happen, you either do it yourself or you get help to do it. But what it means is you have to have a person or a function within the company or outsourced, which is a specialist in the knowledge of the company and which is a specialist in the interaction with the stock market. And that person or that function needs to be able to feed the right information at the right time in full transparency and disclosure to the market so that the market is always in the know of what happens to your stock, to your company, and to your story. Now, let's try and put some granularity into this. Companies disclose earnings on a quarterly basis, right? So every quarter, you have an obligation to disclose your numbers, your profits. Are you making money, losing money? What did you do? So that disclosure should be accompanied by a meeting with investors to give granularity around the disclosure. I mean, you can decide to send, and I remember a time when people used to send handwritten faxes to the market and say, this is my disclosure, right? So now we're talking about a different level of granularity in the disclosure itself, in the dissemination of the disclosure, but also in what happens after the dissemination. Do you have an earnings call? Do you sit down, organize a meeting with investors? Do you open the investor call to questions? Do you actually take the questions? Or are you just pretending? When the questions are asked, and if you take them, do you answer them genuinely or do you not? So that's one example. And we see a very big difference between how companies do things, right?
I think the legendary Warren Buffett does it best.
Yeah, well, there you go. I mean, and his meetings with investors
legendary
have become legendary. And there's a reason for that, right? The guy has nothing to hide. He knows what he's doing. He's been successful at it. And he's not hiding anything of what he's doing. As a matter of fact, he's disclosing. People are copying his strategy. But most of the time, people who copy his strategy are not as successful as he is, which also tells us that just because you tell the market what you do doesn't mean that the market is going to be able to replicate it, because you have a secret sauce, you have a secret recipe, you have a certain know-how, and it's part of your story, it's part of your DNA, and the IR should be a way for you to disseminate this to the market. So earnings meetings are an example. Earnings conferences are an example. Investor meetings are another example. Some of your large shareholders are going to want to call you because they have large position on which they might be winning or losing. And they want to know, what do I do with this? Do I buy it? Do I sell it? Do I buy more? And you do have an obligation to sit with them and to inform them. Maybe they're more educated. Maybe they're institutional, more educated than the retail. They're going to ask you very specific questions about, your numbers. And you have an obligation to do that. Your AGMs, are they public or are they not public? Are you inviting people to come to your AGM?
They have to be public.
Correct. But are they public in the sense that Are you encouraging your shareholder base to come and interact with you during your AGMs? I'm sure your AGM is not the same as Warren Buffett's AGM.
Well, our company hasn't been public as long as his. So maybe in 30 years, it will be as big.
Exactly. And that's what we're talking about. It's about the learning curve and the experience and the progressive walking into that journey. And that's why it's a journey, because we make mistakes, we learn, we do it better next time, but we have to do it. And as a publicly listed company, every publicly listed company has that duty. So if I try to summarize this, dedicated function, internal or external, intimate knowledge and know-how of the company, and full disclosure on a regular basis, at least on a quarterly basis, to your shareholder base.
And this will in turn solidify the relationship with your investors.
Absolutely. And so here you have to fight the perceptions, because we are also in a specific part of the world. And I talked about culture earlier when I talked about other companies and other markets. Our culture, as you know, is a more, I'm trying to choose my words, secretive one. We like to keep things to ourselves, right? And this is in opposition to what stock market disclosure,
what a public listed company should be.
Absolutely. So in a way, if you're listing and if you're benchmarking yourself to the S&P and to the American market, you are going against your DNA. You're going against your culture. And that's very, very difficult. And it takes a long time. So
this is the emerging market predominantly.
And this is the emerging market that we are. And we're going to get there.
Yeah.
And the reason why I say we're going to get there with confidence is because we now know that capital markets are key to us as a country. We know that capital markets are key to us as a region. And we know, because we've seen it in other places in the world, we've seen it across multiple centuries, that capital markets play a critical role in the development of a country, of an ecosystem. And I think there is a deliberate vision, top-down, from our fantastic management to take this to the next level. And I go back to what I was saying about government debt. The UAE government doesn't need debt, yet it issues debt because
it's a transition.
Let's transition.
Every transition takes time. Rome wasn't built in a day, right?
Yes.
So we're doing it the right way. Everything takes time. Yeah. And we are heading in the right direction. That's the most important thing. And that's why we see, at least here in ADGM, hundreds of companies from all over the world coming and setting up shop here.
Yep. And that's what we do at Ramz in helping companies to make that transition. Because sometimes it's easier to have somebody hold your hand and take you through that journey than doing it yourself. Again, we go back to change and to culture. It's very difficult to look at yourself in the mirror and tell yourself, hey, I'm going to change and I'm going to do it on my own, right? So, yes, you're right. It takes time. It's a journey, and we're here to help.
I know we've spoken about the effective IR strategies and maintaining strong relationship with your investors. And we've spoken quite a bit about transparency, but I just want to keep on hammering this point of transparency, because without transparency, you don't get your investors' confidence. And no matter how smart your investor relations strategy is, it's not going to be effective. So can you please emphasize again and again about the importance of transparency?
No, this is a pillar, right? So, and it's part of the narrative. It's part of the evolution of the market. And it's part of us changing ourselves in this part of the world from more secretive, looking from the outside in, to looking from the inside out. And investors are smart. I'm going to tie your question to another key topic, right? If you went to the DFM Capital Markets Conference, which took place a couple of months ago in Dubai, you had a panel with nearly every representative of every regional stock market on that stage having a discussion. And what were they discussing? They were discussing index inclusion. What is index inclusion? You have indices that track the world of investment, the global stock markets. We are part of them, but we are a very marginal part. And when global investors start looking at the region and start buying our shares or the shares of our companies, they make a dent. They make a dent because the sheer size of the assets under management globally is just incredible and much, much greater than our current market capitalization. And the reason why every stock exchange CEO or president or chairman wants to see more index inclusion is because we believe that when foreign investors come in and start buying the shares of our companies, the valuation of our markets is going to go through the roof. And this is what everybody is wishing for. Now, that is only going to happen when we open the books. Back to the transparency point that you were talking about. And I'm going to give you another example. And I hope we're not under time constraints here because you got me going on a very important topic. The investors are going to find the information eventually. So it's up to you to decide. Do you want to make it easy for them to find the information and act quickly on it and buy the story before the stock goes through the roof? Or do you want to give them a hard time for them to go waste time, therefore waste money, trying to find a piece of information that you're concealing from them? And you know what? Maybe they're going to be distracted along the way and go invest in China or go invest somewhere else where there's more transparency. So there's also a global competition here. And if we as a region want to be on the global map, we're going to have to up our game.
What are research orphans?
Oh, yeah, that's a term that I owe to a friend of mine, right? A friend of mine who's been a research analyst alongside me for a while now. And okay, we talked about the S&P 500 earlier. 500 companies, each and every one of them covered by analysts, right? So that means that there's actual research. There's an independent party looking from the outside in with enough information, enough transparency, enough granularity to be able to value the company, write a report, put it out, disseminate it so that the market has more information. And think of it as you as a listed company send an annual report, but then you have somebody else from outside the company sending a research report. So that's credibility, right? So all companies in the S&P 500 are covered. In the GCC, that proportion is maybe 20%. So you have 80% of companies which have no coverage. No third party looking in, no third party with enough information to understand the story and disseminate it.
Why is that? Part
of it is because there's not enough information.
Okay.
Part of it is because...
Not enough transparency.
Yes. Part of it is because the companies are very small. And so let's remember one thing. Investment banks or brokerage houses need to have an incentive to cover a company. Their incentive is because they think they have a great idea. They've identified a fantastic investment opportunity. Let's call it Apple. And they're going to pitch it to their investors.
Let's call it Amer's driving company in Abu Dhabi, for example.
Amer's driving company.
Yeah.
And then the investor is going to believe that recommendation from the investment bank or the brokerage house and is going to buy the shares. Typically, they're going to buy the shares from the same house that gave him or her the idea to invest in those shares. And that's going to create commissions or trading commissions. So this is the usual cycle. I give you an idea, you buy that idea through me, my brokerage desk makes a commission, I grow my business, you make money on your investment, everybody's happy. Now, things have happened along the way, and the regulation has stepped in and has sort of forbidden that cycle. And MiFID II, particularly in Europe, has made it so that research needs to be independent, cannot be related to brokerages, and that investors need to pay for research independently, and then they do whatever they want with their trading. We're not there in this part of the world. So that cycle of I find an idea, I give you an idea, you trade it through me, you make money, I make money, everybody's happy, still exists. Now, if I look at a very small company which is traded in a smaller market, who's going to buy it? Mm-hmm. And if people want to buy it, can they really buy it? Is the stock liquid enough? Yeah. Is it big enough?
Yeah.
So then I, as a bank or a brokerage house, I'm going to allocate and dedicate resources uselessly to a stock that nobody can or wants to buy, and that's a cost to me, and that's a loss to my shareholders.
So that's why 80% of the companies here.
So that's one of the reasons why a lot of these companies are below the radar. They're under the radar. And you know what? They're bound to remain under the radar until something happens. Or they can pay for research and make that happen for themselves. Change their destiny, if you will. Now, I'm going to go back to your question about what do we owe our shareholders? And I said we owe them everything, right? There's no entitlement in the stock market, right? And some companies perhaps believe that they're entitled to coverage. They're entitled to research coverage. But this is a private market, if you will. So you need to give me an incentive to cover your company. Honestly, if I don't have an incentive to cover your company, then why would I do it? Because I'm putting my own money to do that, right? So what's the incentive? And, somehow, sometimes companies have found a way to, make it known that they are hiring somebody to do that research for them. And it works in Europe, and it works in other parts of the world. It's not a practice here yet, but this might change. So research orphans are listed companies that are not covered by anyone and are bound to remain somewhere in the dark. And I also want to tell you something else. There's a very wide pool of investors in the private equity and venture capital space, which go and look for private companies, otherwise not listed. And they spend a lot of time discussing with the companies, with the management, to identify the gem of tomorrow. Here, with the research orphans, we have in the GCC, and in the wider MENA region, we have 80% of companies which have already made the first hurdle of raising money, going public, having the trust, being listed, and nobody looks at them. Now, with nearly 2,500 companies listed in the MENA region, 80% of which not being covered, I'm sure there are gems out there, and we're out to find them.
If you do find any, let us know.
Yeah, we will.
So what would you consider the successful metrics when it comes to a publicly listed company, and that these guys are doing a good job when it comes to IR?
The IR person or function is going to put specific granular KPIs in terms of how many press releases I send, how many group meetings I organize, how many individual roadshow, institutional or retail meetings I achieve, how many calls I answer from investors, and so on. So there are granular metrics that every company should track, statistics, if you will. This is from the bottom up, starting from the base. And from the top down level, there's the share price, right? So if you have a good story and you do a good job in
communicating the story,
disseminating the story in the proper way, and making sure that the story is understood and followed, then your share price should shoot higher. So sometimes, it's not uncommon, research orphans are going to have drifting stocks. Drifting stocks are not Apple, are not Goldman Sachs, are stocks that are volatile with lesser liquidity than the company wishes for, and with a direction which is not unilaterally up, which is perhaps sideways, which is perhaps down, and which in any case is going to be disappointing to the owners of the shares. And I think this is the benchmark. Are the owners of the shares happy with the performance of the shares, right? So if you have a poor story and a poor stock, then you expect the stock to perform poorly. So if the stock performs poorly, you're not disappointed, right? But if you own the shares of a good company with a great story, and the management and the board and the employees are convinced that this story should be somewhere else and the stock price should be somewhere else, then there's something missing and there's something to do. And this is where we step in as advisors to help companies find the right way. And very often, I want to add that very often in this part of the world, the owners of the companies, the founders, the stakeholders, think, perhaps that you can just push a button or flick a switch and that narrative will change. But I go back, it's about the story, and the story is about the journey, and the journey is a long one. And just like human beings, companies have lives, and we should respect their life cycles and accompany them through their life cycles. And that's why we at Ramz have been here and doing this for 25 years. And that's why we hope we're going to be doing it for another
25 years.
25 years.
Here.
In your presence, inshallah.
Sure, yes, absolutely. Multiply has been around since 2003, so that's 21 years.
Yep.
Yeah.
There you go. How many years listed?
2.5.
Yep. There you go. Yeah. So we want to see 25 of those.
Inshallah. Absolutely. Yeah. Definitely. Amer, we have a tradition at the end of the podcast where I ask a question, and that is, if your life is a book, on which chapter are we on?
Oof. So if there's 10 chapters in the book, then we're on chapter 5.
Okay.
Right in the middle.
Right in the middle.
Yeah.
Okay. And how do you see the next 5 chapters going?
Very exciting.
Yeah?
Excitement hasn't started yet.
Hello.
Yes.
Amazing. Amer, thank you so much for your time. I really appreciate it. And thank you for the insights that you gave us today.
Thank you for having me. It's a pleasure, Mandy.
Thank you for joining us on today's episode. Until next time.